We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Gentile. He's a strategic investor in the resource sector and a former institutional money manager. Michael, thanks for joining me today.
Thanks, Tom. Pleasure to be here.
So why don't we start by getting a little bit of your background? You were saying that in the late 90s, you had a very positive outlook for oil. And so how did you learn to start recognizing these opportunities in the commodity space and become really a contrarian investor by heart?
Yeah, it's kind of a bit of fortune. Good luck, I guess. I started my investment career in the late 90s, 97, time period 98. And as you recall, at the time, we were like into the final phases of the dot-com boom, real massive speculative allocation to technology stocks back then. And so all the old economy stocks, as they call them, were deeply out of favor. Anything that made money or was doing old school business was really unpopular in the market, trading very low valuations. And probably the poster child at the time was oil. Oil was really hated. Oil was, I recall, $10 a barrel in the late 90s. I remember a McLean's article that came out saying, oil's dead, and oil's going from $10 to $5 a barrel. So to me, I guess early on, I was always a bit of contrarian, always a bit of seeking value, recording where others were not interested. So that was a great signal for me to get involved in the oil market. And unfortunately for McLean's, they were wrong. Oil went from, instead of going from 10 to 5, it went from 10 to 140, right? So that was my first real lesson early on in my career, 20 plus years ago, about how to do really well in commodities or any sector in particular is go when it's really, really hated. And if you have an outlook that is contrary, or you have a positive outlook when everyone has a negative outlook, that's how you can do really, really well in any sector of the market. But particularly in commodities, because commodities tend to get overdone on both sides, really hated or really loved. So that was a real early example for me of how to time the market in commodities and go against the herd.
Excellent. So that parallels very closely to today, how you see the general markets and the, let's say, the bubble phase that we're kind of seeing right now, right?
Yeah, so I had the good fortune or misfortune, you could say, of living through two major crashes. I call it 2001, 2008, living in the front seat as an institutional money manager, seeing that live firsthand. I'm seeing behavior today, Tom, that I haven't seen ever. And I went through those two crashes, like the level of speculation, excessive optimism, inflated asset prices. Like in 2001, it was, they said, mainly in tech. 2001 top was mainly in tech. Mm-hmm. And the old economy stocks were cheap. In 2008, you had pockets of the markets that were overvalued. Housing in particular was really overvalued. But today you've heard the label, probably other guests call it the everything bubble. I mean, that's really where we are now. Everything is inflated. Everything is expensive, from housing to tech stocks, the market to bonds. Everything is overpriced and overvalued. And why is that the case? It's because the Fed is printing money like a drunken sailor, right? They're just out of control, printing money, inflating the value of all assets. So to me, I haven't seen this level of speculation or over exuberance ever in my career spread across such a large swath of assets. So I am quite concerned. When I talk about Bitcoin, you can talk about online art. I saw an article yesterday, Tom, that a piece of online art sold for $67 million.
I saw that.
A LeBron James video of him doing a slam dunk sold for $205,000, $250,000. This is like ludicrous, right? Like there's just so much money sloshing around. People are making ridiculous amounts of money speculating on stuff that inherently has zero value, right? Mm-hmm. That to me is very symbolic of tops or bubble phases of the market. But what I also learned in 1997, Tom, was that can last a heck of a lot longer than you can stay rational or people think you're crazy, right? So in 97, I was worried about the market. 98, I was worried about the market. 99, I was worried about the market. It took 3-4 years for the whole thing to burst. So I'm not here saying tomorrow is the end, but just for your viewers to be aware that we are seeing behavior that is very unhealthy and very likely to indicate the top or the end of the party at some point in time. And when that party ends, as you know, it's pretty ugly. So I'm very cautious overall on most asset classes and most investments right now in the market.
Mm-hmm. So you were talking about people selling gold because they're worried about rising rates. What should they be 10 times more worried about right now?
Yeah, I made the point. So if you think you're selling gold because rates are rising, then I would say, well, one, you're wrong. We can talk about that in a little bit. But the second thing I would say is if you're selling your gold because you think rates are going to go higher, please sell the rest of your speculative stuff in your portfolio, because that's going to get 50 times harder than gold, right? Why is that the case? If you have a tech stock trading at 40 times sales on the hopes of some profits in 2035, 15 years down the road, if you discount that at 0% in your cash flow discounting model, you can justify pretty much any valuation you want. And that's what's sort of happening in the market. If that discount rate goes from 0 to 2% or 3% or 4%, those valuations are going to collapse epically in the market. So you may lose 5-10% of your gold if rates keep going higher, but you probably lose 80 to 90% in that speculative corner of the market, which is almost every part of the market really that are being valued off of 0% interest rates. So first off, if you're worried about rates going up, I would hang on to gold personally because you'll lose a lot less in gold than you will the rest of the stuff in your portfolio. Happy to talk about the second parallel, which is why I don't think rising rates is actually negative for gold. Well, I do think it's actually quite negative for the rest of the market valuation complex.
Mm-hmm. So yeah, continue there. Why do you think that these rising rates are actually going to be good for gold?
Yeah, so the question is, why are rates rising, right? And there's two camps in the market now. One camp says that rates are rising because we're going to see this robust nirvana-like recovery, and therefore rates are going up, indicating a super strong economy for the next 5-10 years. I don't believe that's the case. I think rates are rising because if you look around you, inflation is clearly picking up. And just, there's inflation you can define by just the price CPI index, which came out today, which I think is a bit of a bogus measure, or the CPI, what I call the index is the stuff you actually want to buy. Like go to the grocery store, try to buy a house, where you actually spending money, fill up your gas tank of car, your gas with gas in your car. Those things are all up substantially, right? Mm-hmm. So real inflation is happening. It's happening as a result of massive money printing that we're seeing. So in that case, rates are going up because of inflationary pressure, and inflationary is a lagging indicator, right? Typically lags the rate move, right? So the knee-jerk reaction is rates go up, gold pays no interest, therefore we got to sell our gold, right? And that's what people are doing. The reality is there is so much debt in the world, Tom, and I could use the US as a poster study for this, but this is true for every single G7 country you want to look at. There's so much debt in the world that the governments cannot afford rates to go up. Even a 1.5%, 2% rate becomes highly problematic for these governments because they cannot afford the interest on their debt. And just to give you some simple numbers, Tom, the US, I saw yesterday, just crossed $28 trillion of debt, 28 trillion. Biden just passed a $1.9 trillion stimulus. So after the stimulus is borrowed to be paid for, we'll get $30 trillion of debt in the very near future in the US. Pre-pandemic in 2019, the US economy was running about as hot as it ever was. Record low unemployment rates, record revenues coming into the treasury. They were taking in $3 trillion a year of revenue and spending $4 trillion. So before this whole COVID mess started, they were running a $1 trillion a year deficit. Mm-hmm. Of that $4 trillion of spending, which they couldn't afford in the first place, $400 billion or 10% of their budget was going to interest expense. If you take the rates from 1.5% where they are today and you go to 5%, which you and I both know, that's a very normal rate on a 100-year perspective, would not be at all abnormal. Mm-hmm. That would be $1.5 trillion per year of interest expense, which would be 50% of their budget, up from 12 to 13% of their budget pre-pandemic. The government is already running a deficit. They don't have this money. So literally the government would be insolvent. And I can even take the number down to 3% or 2% and tell you there'd probably be serious economic repercussions for the US government. So the government can't afford rates going up. That's being ignored by the market. And that's just factual math, heavy math numbers. So what's actually going to happen is rates might be going up because of inflation, but the Fed has already talked about saying we're going to tolerate inflation higher than normal for a short amount of period of time, or we're going to let it catch up to previous levels. Mm-hmm. What they won't come out and say is that we want to run inflation much hotter than our nominal rates. So you run inflation at 5% and you keep rates artificially capped at 1 or 2, that's how you pay back your debt, because you're devaluing the paper money year after year, printing more dollars that are worth ever less, and you can pay back your fixed debt with paper that's worth a lot less, right? Mm-hmm. That scenario, Tom, is the most bullish scenario possible for gold. Because in that scenario, you're not going to want to hold the debt. You're not going to want to hold assets. You want to hold an asset that will not depreciate in value, and that's going to be gold. The negative real rates are the best possible outcome for gold in terms of price action. There's a 99% correlation to negative real rates if you look at the charts. Mm-hmm. And that's what I see coming. It's the only way out for governments to print themselves out of this mess.
But in this new, let's say, age of MMT, can't the government just print enough money to cover its debts?
Well, that's exactly what I'm saying they're going to do. I mean, this $1.9 trillion stimulus that we're calling it, they're just going to print that $1.9 trillion. They don't have that money to send every American the $1,400 they're talking about doing, right? Mm-hmm. Justin Trudeau doesn't have any of the money he's been forking out to Canadians for the last 14 months. Canada on its way even faster to insolvency than the US is, in my opinion. It's a separate conversation. But they don't have this money. So when people get all excited about, our government's fantastic, they're supporting us in our need, they're borrowing that money. They're printing that money. And they're borrowing it from your kids and your grandkids and future generations to make the now better. But someone's gonna have to pay the piper at some point in time, right? So yeah, that's the pushback I get is like, oh, but they could just print money. And I go, well, if that's your view, don't sell your gold. I mean, that is the absolute best scenario for gold. That is what's going to drive gold way higher, I think, in the coming years. So that's the pushback I get. I go, perfect. I've yet to see any pushback, rational pushback, to my view of how do we get out of this debt mess without printing money and without massively devaluing the currency. I've yet to see a rational response. Love to have one of your guests come on and tell me that and have a debate with them, but I have not seen that happen yet.
Absolutely. So, Michael, as we're speaking of these bubbles that are way overblown, let's talk about stuff that is let's say undervalued. And why don't we kind of start speaking about your approach to investing in commodities and being a contrarian, and maybe use copper as your example there.
Yeah, so for sure. So I mean, like I mentioned oil early in my career in the 90s, my approach to any sector, like I said earlier, is be contrarian. So be there when everybody hates it, when there's blood in the streets, when people say it's over. So, copper is a good example as well. And copper, for the last 10 years has been depressed since 2000. Last 2000 run was 2008, 2009 after the GFC. Copper went to about $4, but it's been wallowing under $3 for the majority of the last 10 years, right? There's been no new investment in copper. There's been no exploration. There's been no new mine development. The big companies like Freeport have been licking their wounds, paying down their debt, selling assets. So in that scenario, your pipeline of new supply is very, very low. So the commodities hated. What does that mean? No capital for exploration, no capital for new mines. So when a commodity is hated, what that guarantees is that your future supply is going to be lower, right? They say in commodities, the best way to solve low prices in a commodity is low prices, because low prices will resolve your supply issue if you're oversupplied, or will create a supply shortage in the future if you're not oversupplied in the current period of time. That's exactly what happened to copper. And then you have this incredible turbocharge where almost overnight, right? You have the election switch in the United States, and governments around the world the last 5 years have gone this massive green push. And electrification is great, but in order to electrify your country, when you've been running on a carbon-based economy for hundreds of years plus years, is you need massive infrastructure. And copper is a conduit for electricity. So you have this massive demand push that's going to happen on copper, while at the same time your supply has been underinvested for the last 10 years. So, I would say I was moderately bullish on copper a couple of years ago. As I've seen the demand picture expand dramatically, I've become really bullish. Because your supply is constrained and your demand is definitely going to be way higher than it was in the last 10, 20 years, in the next 10, 20 years. So that is a perfect recipe for commodities increasing over time. I'm not here to say copper is going straight to $6, but over the long term, we need a price signal for those copper producers to get out their shovels and get a bunch more copper out of the ground. Otherwise, we're not going to be able to electrify the grid that we want to do in Canada, the US, and globally in Europe and Asia.
And not necessarily even shovels yet, but more drills to be able to expand their resources and find that copper to be able to get the shovels into, right?
Exactly. If this green agenda goes through all the way to its end, Tom, this is a 20 to 50 year cycle we're talking about here. So you're going to need existing mines to produce more, and you're going to need early stage exploration projects to go find massive amounts of new copper discoveries. And they're going to be lower grade because most of the good stuff globally has been mined at high grade already. So it's going to be inherently higher cost projects. That's why you need $4 or $5 copper in the future to incentivize these new miners to both go drill it and then get the capital from the markets to go build these multi-billion-dollar copper projects to supply the next 10, 15, 20 years of supply.
So, Michael, are you mostly focused on, let's say, the commodity equities in this space and like more on the junior side, or how do you really think about your focus here?
Yeah, so if I find a sector, like I said, or a commodity that's hated, Tom, that I see a positive demand backdrop, like I saw oil in the 90s or copper or gold 4 or 5 years ago, to me, if I really am convinced about the bullishness or the potential for the price of that commodity to increase, to me, the best way to make maximum returns is to be in equities because they inherently have a lot more leverage to the price. You could buy copper at $2 like it was a couple of years ago, and it's gone to $4, you made 100% of your money, right? Or you could buy a copper producer that has $2 cash costs, who's producing copper at $2 and making no money, right? And suddenly copper goes to $4 and they've made 100% increase on their margins. They probably made 50 to 20, 30 times your money on the stock, right? So for me, the maximum leverage will be in smaller copper, gold, whatever commodity you like producers, and then the earlier stage stuff that has the potential to make a major discovery into a market that's going to dramatically appreciate the value of that discovery much more in a rising commodity price environment. So that's typically where I spend my time. I don't spend much time trading commodities. People can do that, but I see much more value in the equities.
Excellent. So why don't we get into some of the, let's say, the types of investments that you look for in the gold sector?
Yeah, so there's basically 3 buckets of investments, Tom, that I would look for in the commodity sector. I'll go from biggest to smallest, and I like small. I spent 17 plus years institutional money manager, focus on small mid cap. So I think small is beautiful. I think you make maximum returns on smaller companies because they're less followed, less understood, more likely to find a hidden gem. If I'm here to tell you I know some nugget about Tesla or Apple that nobody else does, I'd be lying through my teeth, because there's a million people that follow every move those companies make every single day. But small companies tend to be underfollowed. Very few analysts following them, very few people doing their conference calls or talking to the management. So you have a chance of finding something unique and mispriced. So that to me is the first call. So I like small. So I go from biggest to smallest in my arena. I like small single asset producers of any commodity. So they might have one mine or two mines. That'd be sort of where I like to live. The reason being there, Tom, that if I can find a high quality single asset producer or company with one or two mines that has lower costs than the rest of their peers in the industry, they become very attractive takeover candidates for the bigger players who want to upgrade their portfolio, right? So that's one area I like to see. And they also, Tom, trade at very large discounts. So a single asset producer might trade at 0.4 times NAV and maybe 3 times cash flow, where a bigger multi-asset producer like a larger companies like Kirkland Lake or someone, or like Endeavour Mining in Africa, they may trade at 6-7 times cash flow, maybe 0.8 times NAV. So there's a natural arbitrage there where if you're a bigger player and you buy a smaller producer, you can buy that at half your valuation, put it into your larger company, and the whole thing will trade at a much larger valuation. So there's a natural accretion that comes. So that would be the biggest company I would look at. The second level of company I would look at would be companies where they've made a discovery. They're still in the resource stage or the discovery phase, but I want to identify as early on as possible that this asset has true potential to become a mine. So before the market realize it, before they have a PEA, preliminary economic assessment, a feasibility study, before it's obvious to everybody that this discovery is going to be a mine, I want to get in on those companies as well, because they're going to be very likely to become producers. And that evolution from discovery to certainty of production, there's a huge amount of value that gets created there. And the earlier you identify those companies, the more money you can make. So those would be companies that have anywhere from say 30 to 100 change $1 million market cap. And then the third level will be the really earliest stage, like really early, grassroots exploration, where I'm getting involved in companies that maybe have a $5 to $20 million market cap, where I see huge potential for discovery. And typically, I go through some of the criteria I like for, but typically an existing mining camp where there already are producers and mills and infrastructure and power and roads, et cetera. So if you find new ounces in those type of locations, they're very valuable economic ounces, but you don't have to build all the infrastructure that the big company next door has already done. So really promising grassroots, early stage exploration would be the third bucket of companies that I would look for. And I diversify my portfolio among those three different buckets.
So in that third bucket that we just spoke about, Michael, do you take a lot of, let's say, jurisdiction or locational data into that? The old saying of the best place to find gold is where you've already found gold. That makes a lot of sense in that case, right?
100%. So if you got the land or the infrastructure next to a high grade operation or existing mill, the best, as you said it perfect, the best place to find gold is right next to existing gold discovery, especially if it's high grade and in production. So that's definitely a key attribute that I look for. To more crude term, it's not like industry closeology. You're close to existing discovery. People get carried away by that. Just because you're next to an existing discovery does not mean you're going to find anything. But if you do find something, it's going to be a heck of a lot more valuable. If you're stuck in the middle of nowhere with no access and need to provide all the infrastructure yourself, it's very expensive, right? You mentioned jurisdiction, and I'm not sure if you're going here with that, Tom, but jurisdiction is really important. But I think it oftentimes gets misplayed by the market, so to speak. So obviously Canada and the US are great places to mine, but there are pockets of Canada and the US that are worse jurisdictions than being in some politically sensitive countries because of either environmentalists or certain social licenses you may need from communities to mine. Some parts of Canada are just completely off limits for mining. So you might see the word Canada on the company's presentation, but they might not be able to get anything done in Canada. And you might want to go to West Africa, which has obviously more political risk. People might get cold feet, or other more exotic parts of the world. You might be a little bit worried about government stability, et cetera. But in those parts of the world, they are very pro-mining. They want, from a discovery to production. I've invested heavily in a couple of West African companies, and that's probably the place in the world where you can move a mine from discovery to first production faster than anywhere in the world. And why is that? Because they want the cash flow. They want the jobs. The government wants the economic activity. You make a discovery in certain sensitive parts of Canada and the US, it might take you 15 years to get a permit. No joke, right? Whereas in West Africa, you can make a discovery and be in first production within 2 or 3 years. So to me, jurisdiction is more than just what's the political risk, but it's also what is the environment for mining, how supportive is the government of mining, and how quickly can you move a project from discovery to production, because that has a dramatic effect on your net asset value, your discount of that project, right? So jurisdiction is much more nuanced and much more layered than just putting labels of country A is good, country B is bad. You really have to go in the weeds, understand the motivation of the host country, understand their position on mining, understand their desire for development, and also understand the company's ability to navigate those issues, both locally and at a high level, to move the project to a full completion.
So, Michael, can we talk a little bit more about let's say, the political risk of some of these jurisdictions, and maybe do you ever take into consideration let's say, the debt of the country and the risk of nationalization of a mine like that?
100%. That's sort of, you nailed it, Tom. That's the one area I would look at. If I have a sense and a concern that nationalization could be on the table, I'm either not going to invest or I'm going to heavily discount that project, like by applying a very severe multiple discount or a discount rate, a very high discount rate to get a very low valuation on that project. So, like I said, and there's some countries that have histories of nationalization, some countries that have done it many times before. You also have to kind of test the wind. What's the government situation? How stable is the government? When's the next election? Are there anti-mining or nationalist kind of parties that are in the wings looking to take over? It's a messy science. It's never perfect. But yeah, nationalization to me would be the biggest one. What tends to happen, Tom, is initially when a country is in development mode, they're desperate for investment, right? And they want investment. So nationalization would be like, basically, if you nationalize a mine, your country's off limits for the next 10 years for foreign investment, right? So the countries that need foreign investment, that get a lot of money in the ground, they're very pro-mining. And then it comes a certain point where they maybe get more comfortable and they're starting to make a lot of money from mining. And that's a danger when you have a more left-leaning ideology that might come in and say, well, we're going to take more of the pie, more of the pie, more of the pie. And then all of a sudden, what they don't realize is if you nationalize a few mines, all the mining companies leaving your whole industry is basically back to square one, zero again, right? So early on, companies very pro-mining. As they get more and more successful, there's a danger that they may shift that way. And you have to be constantly aware as an investor where the winds are blowing and what's the likelihood of that kind of following through on that threat.
Mm-hmm. Well, we both know, Michael, that politicians aren't necessarily great at looking towards the future. So I guess to look at that that risk of how they're thinking about nationalization, that's never, as you say, never very stable, right?
It's a moving picture typically, but it's as much noise as you make about nationalization, it tends to be very rare. Mm-hmm. Because again, the countries that have gone the nationalization route have become pariahs for foreign investment. There's not many companies. I'd be challenged to your viewers or future guests to tell me, show me a country that's gone the nationalization route that's had a rich economic outcome on the back of that, right? They may have had a few good years where they've milked the existing mines for more cash than they would have got if the producing company had stayed. But then after that, the industry typically falls apart, right? So you haven't seen any success stories of nationalization, which is why it's much more rare than people would actually believe when they talk about jurisdictional risk.
Excellent. So why don't we move on to talking a little bit about the importance of boards and insider ownership in some of these junior mining companies?
Yeah, so I spent 17 years as institutional money manager. I focused very heavily at the time on the CEO, the chief operating officer, the CFO, perhaps the chairman of the board. But in all honesty, Tom, I've learned a lot when I've switched to running my own capital and getting heavily involved. Full disclosure, I'm a director of 4 different companies right now. So I've learned a lot on the other side of the table by getting my hands dirty and rolling up my sleeves. I'll be honest, I didn't spend enough time on boards when I was an investor on the other side of the table. And now kind of becoming a high 10, 20% investor in some of these companies, becoming a board member of them, I realized the dramatic importance of boards. And why is it important? In particular, the smaller the company, the more important the board is. And I'll explain why. Most junior companies that your viewers probably follow, Tom, if you go to the website and pull up how many full-time employees do they have, I'd say they might have, my guess would be anywhere from 2 to 5. And 2 is common and 5 would be probably a big team for a junior exploration company, right? So if you have 2 to 5 full-time employees and your board is 5 to 6 people or 7 people even, there's more board members involved in this company than you have full-time employees, right? So at that level, you're not running Coca-Cola with millions of employees worldwide and 6 board members. Your board members outnumber your full-time staff. So when I joined these boards, I wanted to see, like I was, a highly invested board, which own lots of stock in the company. Therefore, they care very much about the share price outcome for their shareholders. I wanted to see board members who, don't want to just do 4 meetings a year, once a quarter, and check in on the assets and give some advice to the CEO and then go back to their day jobs. I want to see board members who have expertise in mining, capital markets, and exploration that are willing to roll up their sleeves and contribute, not as a full-time employee, because that's unreasonable, but willing to commit a significant amount of hours to drive the company forward. Because that automatically increases the horsepower of your business. And I want to see a board that has a diversity of talents, where they're well represented on the capital market side, on the development side, on the exploration side, on the legal side, when you have a well-rounded team, it's almost like a mirror of your full-time staff, or can lean and help support the full-time staff more fully. In those situations, your outcomes are going to be much, much better in the junior exploration space. And unfortunately, it's because they're small companies and there's a lack of talent. Oftentimes boards are underweight or underrepresented of quality in the junior exploration space. So I encourage your viewers to really spend a lot of time looking at the composition of the board, get to know them, and get to know how engaged they are in the process of creating value for you as a shareholder.
Mm-hmm. So when we talk about the importance of the board and the team around this, let's say an asset, tell us a little bit about your thoughts about how you really want to, let's say, identify a team that is able to get a project into production, that is a recipe for getting the maximum value for their shareholders by forcing a major to take it out of their hands by paying a price that they can't refuse.
Yeah, so I'd say in my two smaller buckets, I've got like an existing discovery that's been made that I'm convinced that there's an producing mine in the future, or when I'm looking for a junior early stage exploration company, what I hope them to find, I'll walk you through my criteria that I look for to make me convinced that there's going to be a mine here in the future and that a major producer would want to own it in the future. The first one, Tom, is grade. Grade is critical, and grade is the margin. In any industry, the margin of what you're selling is super important for profitability. So the higher the grade, the better. That makes a project very unique and very desirable to larger companies. Second is scale. I mean, scale is critical from a sense that if you want it to be a mine, you have to have enough of the material at high grade to make it economically viable for more than a couple of years. So you want to have a mine life of at least 10 years and enough scale that a bigger producer can buy that and it's actually meaningful to their portfolio. The other two are you already asked some great questions on location and infrastructure, right? So political risk, and also what's the infrastructure? Are there existing mills, roads, power, water? Are there lots of operating mines nearby that can leverage your discovery? And are you in a country, like we talked about earlier, that will allow you to move that from discovery to first production? Mm-hmm. And then I also want to see a fifth point be exploration, sizzle, or upside. So, you may have a really good discovery already that you feel has the potential to become a mine, but even better if you've got lots of blue sky to make additional discoveries to either increase the mine life or to dramatically increase the size and scale of the project, right? So that's really important. And then, like I said, you asked another great question. You want to see a heavily vested board and management team that own as much stock as possible, that are highly aligned and motivated with shareholders. My disliked management teams are when they only own options. They're just there for smoking a hole and exploration success, like buying a lottery ticket, but they put none of their own money in the game, right? When you write a check and become a big investor in your own company, on the management board, you're going to be sweating it out at night, right? If you just own some options and getting some cash salary, and if we had a great exploration success, the CEO's rich. If we don't, we try again somewhere else. Again, that works sometimes if you're lucky, but I really rather the guys that are owners, thinking like investors, and are sweating every single decision so the company will be moving forward successfully in the future. So that's sort of my recipe. They're hard to find, but if you have those attributes in a single company, the odds are increasing on your favor of having success.
Mm-hmm. So, Michael, let's move on to talking about how these companies really finance themselves and get operating capital to be able to move these projects forward. So, what are some of the common mistakes that they make?
Yeah, that's another great question. I would say, Warren Buffett has a saying, which I've morphed and adapted for the mining and resource industry. So Warren Buffett has one of his famous sayings in the stock market is lesson number one of the stock market is never lose money. And lesson number two is don't forget lesson number one. So that guides his conservatism and his desire to think about downside first, upside later. I adapt that to the mining industry, especially junior exploration or non-cash flowing assets. My number one rule for mining companies is never run out of money, right? That's rule number one. And rule number two is never forget rule number one. Because that is, you can have the best project in the world, but if you're out of capital, you run out of cash, and you're a business that consumes cash without any cash flow coming in, which all exploration companies are, that's when your stock price gets obliterated. And that's when you're forced to make some really hard, messy, dilutive decisions to keep the lights on of the company, and you're issuing shares at very low prices that dilute the existing shareholder base. So the first thing, and as you know, Tom, commodity markets are inherently unpredictable, and they can go up and down, swing very wildly. So markets can get close. Try raising money for an all stock in 1998, almost impossible. Try raising money for copper a couple of years ago, very, very difficult. So you don't know when those commodity windows are going to slam shut on you. And if the door is slammed shut and you're out of capital, that's when your shareholders get obliterated and lose a ton of money. So the companies I'm involved in, I always want them to be extremely well capitalized, have at least 2 to 3 years of corporate G&A in the bank, and have plenty of money in the bank to fund their exploration needs, at least for the next 12 months, preferably longer. So that if those market windows slam shut and you're unable to raise equity at terms that are advantageous to your shareholders, you're not forced to take a bad deal. And a lot of companies live hand to mouth. They forget that. They think that they did their financing 6 months ago. The market will be there for them a year. It may not be the case. So that's the first rule. The second rule is, okay, you need money, great, but who are you raising money from? Like, look more carefully at your shareholders. And you know, the markets are all kind of investors, right? And they all serve their own purpose, and they're all, you know, create liquidity and make some market. But if you're going for fast money, you know, if you're going for, I don't know if you heard the term warrant clippers before, Tom, but you know, if you do a deal with a warrant, it's fine. Some shareholders are good quality shareholders, and a warrant will actually be helpful because they can exercise that warrant in the future and bring future cash to the company. But some shareholders will buy a deal only for warrants. As soon as the 4-month hold is up, they'll sell their shares to keep the warrant. It's a free lottery ticket in their portfolio. So you create that fast money kind of churn in your portfolio, right? You guys may be aware of flow-through money, right? So flow-through investing, tax advantage dollars in the resource sector and mining in particular. Flow-through investors, again, it's great for the companies. They get to raise money at a higher price than they otherwise would. But if you take money from guys who just want the tax credit and they're buying the flow-through shares, 4 months later, they're selling the shares because they're getting the shares at, you know, 50 to 70% off the regular price because of the tax credit. Well, they've got low cost paper. No matter where the stock is trading, they've made money. They're going to sell your stock, right? So you've got to be very careful of who you raise money from, right? Mm-hmm. And then obviously, if you can attract shareholders that are long-term partners, the ideal, who will fund your first round when you're a $5 million company. And if you have success, they have the financial means to fund your $10 million round when you're a bigger company or a $20 million round when you're bigger. And they want to continue investing in the company. Those are great. When your existing shareholders are writing additional checks in the future, those are the shareholders you need to attract. So that's a wish list. You can't always get all of them. Sometimes you got to take what the market gives you. But the companies I work with, I want to spend a lot more time with them. Say, let's work a bit harder to try to find the high quality money than take the easy money. Right? Take the money that comes easy, but is going to cause long-term problems for the company. So that's a lesson I think I'm trying to teach a lot of companies I'm involved in. Is work a little harder to try to get a real quality shareholder base that are supportive, that will be sticky and there for the long term.
Long-term problems and maybe long-term dilution, correct?
Yeah.
So
exactly.
How do you look at that as, let's say, a board member of a company, of walking that tightrope of issuing, let's say too many rounds of financing with warrants attached? Like, how do you try and again, just basically walk that tightrope or that knife edge of trying to attract capital without issuing too easy of terms for it?
Yeah, and that's very tough. So the market will dictate the terms, right? So if you're a junior exploration company with a $15 million market cap, doing a deal without a warrant, unless you get a strategic investor like a corporate or a very large investor who wants to own 10% of the company, you're very unlikely to be able to do a deal without a warrant. Mm-hmm. So fine, that's the market terms. You got to do it. If everyone else is doing a deal with a half warrant, you got to do a deal with a half warrant too. What I'm saying is then if you offer a half warrant, go very carefully through your shareholder list and make sure the shareholders are in that book. Our shareholders are going to hang on to your stock for multiple years. And if they have that warrant and it has the fortune to be in the money in the future, maybe be willing to exercise that warrant early and give the company, cash 12 months or 24 months earlier than the warrant otherwise would force them to avoid further dilution, because they're thinking like an owner and not like a fast money, fund who wants to clip the warrant and move on, right? So that's where I say, yeah, you need to do it. I've done deals with warrants in my companies. You have to do them, but spend extra time and hustle to find those shareholders that are going to be partners with your business and not looking for the warrant as an incentive that they're going to hang on to it and sell your stock, right? Mm-hmm. And it may mean taking less money, may mean saying no to other investors who want to come in on the deal because you identify them as such. You identify them as undesirable or less desirable shareholders for the long term versus a desirable shareholder. So I'm okay with giving warrants to the right shareholders, but that's the nuance that a lot of companies have to understand when they're financing their companies. But again, beggars can't be choosers. If you're running out of money and you're out of cash, you have to take, if you need $5 million to keep the lights on, you're going to take whatever terms come your way. Mm-hmm. But if you have the good fortune of having $15 million or $20 million of demand on a $5 million financing, well, you can high grade that list and make sure that you're optimizing your shareholder list for the long term.
Mm-hmm. And how do you actually go about that, Michael? Do you have, let's say, a team that has some type of investor relations and actually talks to those shareholders, or how do you actually go about figuring out and trying to retain those shareholders, those high quality shareholders?
Yeah, so marketing is very important for companies. I mean, I think it's networking. I've been 17 and 20 years in the institutional money management business, so I know a lot of connections on the street to brokers that have connections with institutional funds. I know how those funds think. I know what they look for. And those funds are looking for a lot of the same attributes that I shared with you earlier, right? So if you bring them quality ideas with a solid management team, a solid asset, a thesis, a board that's going to protect the value of their investment and do the best they can to optimize it, you can attract higher quality shareholders, but you also have to take the time to do the meetings, talk to those shareholders. You might do 50 to 100 institutional meetings, and you only have 5 or 10 that are interested in the company, but you've got to do those 100 meetings to find the 5 or 10 that it's the right fit for their portfolio, right? So it's a constant process, but I tend to try to target as much as I can a quality shareholders and looking out for them. And then, you know, the other pockets of money will probably come your way whether you look for them or not. They'll be knocking on your door. Where the ones you really want to show as a company, you got to seek them out and let them know that the opportunity is there to invest in a quality company.
Mm-hmm. So the one other mistake that we didn't cover yet is too much cheap paper financings pre-IPO. So tell us a bit about that too.
Yeah, so that's would be in the earliest stage companies that I see in the market, Tom. The group that puts together an expiration land package, let's say, and wants to bring the company public. Obviously, to tie up the land, whether you're in Canada or Chile or Australia, wherever you are, you tie up a land package, you need some money, right? So you've got to have a founders round at some point to get the land package together. But what I often see in the industry, which I'm not a big fan of, is let's say you do initial financing at 5 cents a share to tie up the land package for 250 grand to buy the land package. And then before you go public, you do a 10 cent round, 15 cent round, a 20 cent round, which are just rounds basically to see people in your network, right? And the asset hasn't really moved forward. Like you haven't done any exploration work on it, you haven't done any, significant advancement to the asset. And then you come public at 50 cents to $1 or something, right? And the same asset, but now you come public where you have, say, 40 million shares outstanding at 50 cents, $20 million valuation. But those 40 million shares have a cost basis of between 5 and 10 cents, right? So the stock opens at 50, goes to $1. And then what happens is every piece of good news that comes out, you have drilling success, which is fantastic, but people are sitting on gains of 800 to 1,000%, right? So they're selling all day long. And the folks that bought the IPO, they're not selling because they haven't made a lot of money, but they're scratching their head saying, why is my stock not trading higher, right? Mm-hmm. So I'm all for, exploration is a risky business. If you found a company, you should have early stage investment. It will be very, very low cost. Mm-hmm. But you want to be careful when you look at a new investment, what do the shareholders come in at, right? And how much paper is there that's coming off lockup or escrow that's going to be free trading? That could be an overhang on the stock. In the same way warrants could be an overhang, a bunch of cheap paper early in the founding of the company that's coming off restriction can also be an overhang. It's more of a timing issue. It might be a fantastic asset, but that'll more time and dictate, when I want to get in, when all that paper has been cleaned up and all that the early money is out, and now the stock can trade, more freely without having the pressure of a lot of people sitting on big gains in the stock.
Mm-hmm. So you're more looking for companies that are actually creating value in these projects before the IPO, not necessarily just trying to get these rounds of financing in before they go IPO, right?
I mean, the ideal situation is that myself and other investors can come in at a valuation close to or at the valuation where the founding players have come in. And there should be a markup because I believe very heavily in sweat equity, and I believe it's not easy to find a good project. So those founders should earn a good return on their money. But I want to be as close as I can to we've acquired the land, we're about to drill. I'd like to give the money for drilling at not too large a markup versus where the land was acquired at, right? Exactly. So you acquired the land for $1 million and I'm in at 5, that's fine. The founders have made a great project, I like it. If they acquired the land for $1 million, I'm coming in at $50 million or $100 million valuation. Mm-hmm. That to me is a recipe for a short-term or medium-term stock price underperformance, as all that huge gains that have been founded by the group put the project together kind of get filtered into the market.
So a term that's normally heard in this space, exactly as we're talking about these smaller junior companies, is a tight capital structure. So can you explain to us what that means to you? Yeah,
so it's a bit of playing on what I said earlier. If there's a lot of loosely held paper in faster money's hands. So what I look for, Tom, is companies where the top 20 shareholders, the top 15 shareholders own 50 to 70% of the shares, and who they are. They're sticky. They're loyal. They're supportive. They've bought previous rounds and will buy future rounds of financings to finance the company. That's a nice tight capital structure. The opposite would be a structure where 70% of your shareholders are flow-through tax investors, where their cost basis is well below the current market price, where they bought the investment for a tax break. Or they're, like I said earlier, 70% of shareholders are investors that have a 2-cent cost basis in their stock and are looking to play the next deal, and the stock is up to 50 cents. They're eager to sell. So that's a big difference, right? So when you look at good news coming out in the market, exciting new drill hole, brand new discovery, if you have a sticky, tight shareholder base that's there for the eventual takeout or there for the building of the mine in terms of creating maximum value, versus a group that's there more faster money, that's looking to make a quick buck and move on to the next one. That's going to be a whole lot of paper to absorb in the market, a whole lot of shares are going to be sold in the market, right? And that's going to probably overwhelm the news activity of the stock in the future, right? So that's where a tight share structure that's well built with the right type of shareholders can make a big difference in your valuation in the market.
Mm-hmm. Excellent, Michael. Do you think there's anything else in that space that we need to touch before we move on?
On the financing, I think we've covered a lot of ground. I mean, and like I said, also, like, don't forget to overcapitalize these companies. I think it is really important. You're in a business that the companies burn through cash. That is their business model, is they burn through cash, and their way of making money for their shareholders is discovering something that's special and unique, that's so valuable that a bigger company will want to bring it to production, or that the market will want to reward them and allow them the capital to build it. So if you're in a business that consumes cash, don't run out of money. That's really the advice I give any company I talk to.
Excellent. So, Michael, how do you go about thinking about the mergers and acquisition targets in this space? Do you like to try and find those if you haven't gotten them at the early stage?
Absolutely. I mean, that is, most junior exploration companies that either I'm involved in or that your listeners are involved in do not have the wherewithal to build a mine, do not have the technical ability, the resources, the team, the experience required to build a mine. So if they do tell you they do, that's a big red flag actually for me. In certain cases, I'm involved in a few companies where actually they do have put the team together where they could do it. And even that team is like, look, we can do this, we can build the mine, but we'll also open to M&A if somebody wants to come in and buy us, right? So yeah, absolutely early. I'm looking for projects where I see, based on my 20-year plus institutional money management experience, the larger companies that I used to invest in as an institutional fund manager love these attributes, are desirable, and can see potential to be acquired. So you never want your thesis to be, I'm buying this company for a takeout, because takeouts happen much less often than your viewers would hope. And their portfolio, there's lots of options for companies to buy. But if you buy companies that have the attributes that make them desirable to be a takeout target in the future, it's quite likely the stock market investors will fund those projects as well. So you have the two options of getting a real valuation in the market and getting funding to move your project forward, or a corporate coming in and offering you a price that you can't refuse, and therefore takes it off the table. I mean, GT Gold is a great example. As you saw this week, GT Gold got bought up by Newmont for $450 million at a 78% premium, which is extremely rare, a premium that large, right? Mm-hmm. But that's what I think we're going to see a big wave of M&A coming in the sector. And I think that's just the tip of the iceberg in terms of the potential. So you're going to see a lot more of that. And projects that have the capacity to come onto production in the medium to long term are going to be highly desirable for the larger companies in the sector.
So, Michael, give us some of your reasoning on why we're going to see more M&A in this space coming up here.
Yeah, there's multiple reasons, Tom. I mean, first of all, in any mining in any mining business or any resource business, you produce, you're declining, your reserves are declining. So if you're a company that has 50 million ounces of reserves and you're producing 5 million ounces of production per year of gold, you will be completely depleted in 10 years. You'll be out of business in 10 years. So there's a natural treadmill or tension in the industry of these larger producers that need to replace their production, right? And we mentioned earlier, when sectors are out of favor, there is no exploration spend, right? And more so, the senior producers, typically, even when times are good, typically don't invest enough in exploration to replace their portfolio. When times are bad, they do even less. So we've been through a period now in gold, copper, where you see no investment. The producers have been managing their business for cash flow for the last several years, because times have been tough, not replacing their pipeline, not replacing their reserves. And so now that prices are up, and people want to see growth, people want to see the companies maintain those production profiles, they're looking at the cupboard and going, our cupboard's bare. We have no capacity to replace these existing production that we have currently in our portfolio. So you're going to see, I think, a big wave of acquisitions in the earlier stage exploration developer companies, and you're also going to see a big wave in those kind of single asset producers. So companies can kind of plug the holes in their 10-year production profile, missing holes in their profile to maintain that production, even grow their production in the future. The second dynamic, Tom, that I see happening is, as an institutional money manager, when my fund was focused on small caps. So I was probably one of the few investors that would go down the market cap spectrum. And even at my old firm, our limit was you can't buy anything less than $250 million market cap. And we were a bit of mavericks in that sense, that most people are $1 billion, $2 billion, $5 billion is their cutoff, right? So if you're under $5 billion market cap, probably 90% of the institutional money that's out there is no go for your company. So you have a natural lack of funds. That's why these companies trade at lower valuations, because the larger companies get more wallet share of the big institutional money, right? Mm-hmm. The third reason is this big trend towards passive investing you see in the market. Over half the money in the market is now passive, and those passive investors are all buying index funds. So the index funds are all lined up for the largest companies in Canada and the US. So again, if you're below a certain market cap, under $1 billion or so, you're not getting into any of the indexes either. So again, there's a lack of funds, right? So it creates this natural arbitrage or valuation gap between the larger companies and the smaller companies. And as I mentioned briefly earlier, you're a larger company trading at a bigger valuation, you buy a small company trading at a low valuation, it's naturally accretive. So not only do you need to replace those production profile reserves that you're lacking, but buying these smaller companies is wildly accretive because that same cash flow, those same ounces are going to be valued at 50 to 100% higher in a larger company's portfolio than they are in a small company, which from a cash flow finance perspective makes no sense because cash flow should be cash flow and value should be value. But in the market, that's how it works. So I foresee a big wave of M&A. I think the catalyst, Tom, is going to be COVID hopefully finally leaving us and allowing site visits to happen again, because you could do a lot of work for your desktop, spreadsheet analysis, cash flow analysis, reserve analysis, talk to the companies. But before any significant M&A happens, a site visit is essential, right? To kick the tires, let the technical guys really make sure what the company says is there is actually there. Mm-hmm. We've been basically unable to do site visits in 90% of the world for the last 12 months. So I think there's a lot of deals that are sort of backed up in the pipeline, waiting for those site visits. And I think the pullback you've seen in the market on the gold stocks in particular has made a lot of these targets much more appealing, as witnessed by GT Gold's 78% premium. That was deals probably in the works for several months, finally got over the goal line, and the stock pulled back, and the buyer with Newmont saying, this is still worth $4 a share, your stock's trading at $2. Mm-hmm. I'm doing the deal anyway. I don't care what the market's done the last 2 weeks or 3 weeks or 4 weeks, right? So I do expect a big wave in M&A, and I think that's going to light a fire under a lot of these stocks in the coming months once that gets going.
Mm-hmm. What about mergers between single asset producers?
Yeah, that's another way to create value in the stock market. So again, I mentioned earlier, the larger, more liquid companies that have multi-billion-dollar market caps will trade at much higher valuations in the market. So if you take two single asset producers with let's say $500 million market cap each or lower and put them together, all of a sudden they have 2 or 3 producing mines. You eliminate a single country risk. We talk about nationalization or political risk. If you're producing in 2 or 3 different countries with 2 or 3 different mines, your risk profile is lower, your market cap is higher, your trading liquidity is higher. You get to go into indexes, you get to go into the more passive pools of money that can invest with you. Larger fund managers will look at your stock. So yeah, if you have 2 stocks, single asset producers, they're called merger of equals. We've seen a lot of those in the last kind of 2 years in the gold space. You put 2 companies together, typically they'll get a much higher valuation in the market. And they can pull a lot of G&A and costs. You need 1 CEO instead of 2. You need 1 board instead of 2. You need 1 lawyer and legal advice instead of 2. So you can pull a lot of G&A out of it. So there's a lot of logic to, single asset producers coming together become mid-tiers, and then mid-tiers coming together become seniors. And even the seniors like Barrick and Randgold and Newmont and Goldcorp, they merge together to become super majors. I don't mean to call them super majors or super seniors, right? Mm-hmm. So I think you're going to keep seeing that more and more happening in the industry. But it's going to put a lot of pressure on those companies. The bigger you get, the more ounces you have to replace every single year, right? So if you're a 2 million ounce plus 2 million ounce, you're a 4 million ounce producer. Well, now you got to find 4 million ounces next year. Mm-hmm. So all that does is put more pressure on those bigger companies to find really high quality exploration, development, single asset producer companies to fill that void, because they get hungrier and hungrier the bigger they get. So I think that's going to also feed the M&A wave I expect to see in the coming years.
Mm-hmm. And of course, as these companies merge and become more efficient, that frees up capital to fund exploration. And also, if you have the gold price move up, that has the same effect, right?
Exactly. More cash flow to invest in growth or other acquisitions in the future, right? So it's a logical progression. The gold industry has, Mark Bristow of Barrick has made that point. It's dramatically fragmented versus other major commodity producers. You look at like iron ore or even the oil industry, much more consolidated than the gold industry. The gold industry has been crying for consolidation for many years. I think that's going to continue. But I'd much rather be investing in the targets rather than the companies that are doing the consolidation, because you're typically going to get a much better return on owning the targets than the companies that are actually doing the consolidation.
Mm-hmm. Excellent, Michael. Are there any, let's say, particular areas that you're really excited about right now?
In terms of stocks or commodities or?
Yeah, in terms of, let's say, jurisdictions or M&A targets, anything like that?
Yeah, I'm definitely really bullish on gold. I have the lion's share of my money in gold because of my concerns about the stock market itself. Gold is the only commodity that you can look at that in an economic downturn will not see the supply fall. The demand fall dramatically, right? So, the good thing said about copper or even oil or zinc, whatever you're talking about, in an economic slowdown, the demand is going to slow down. So those commodities will be inherently more effective than gold will be, which will regain its luster as a safe haven. So I like gold. I do like copper long term. I think zinc is out of favor. But in general, Tom, if I think a commodity has a decent backdrop, I much prefer looking for the real star companies in that sector that have the grade, the scale, the location, infrastructure that can make money at commodity prices that are half of where they are today. A standout project like that is inherently valuable in any commodity cycle. So I'd really much rather focus on bottom up, finding fantastic companies. And then if I have a positive outlook for the commodity as well, then I'll overweight my search in that corner of the market. But for me, it's all about bottom up, finding the best companies that'll make money any commodity price. And if I get a bull market for the commodity, it's going to turbocharge my returns in the future.
Excellent. Do you spend any time thinking about trying to find high-grade silver projects? I know that there's very few, let's say, companies that are focused on solely silver, but do you try and identify any of those?
So I'm a contrarian, I guess you can probably tell by nature as our discussions evolved here over the last little bit here. And I would say the reason why I stay away from silver, I don't have a negative view on silver. I don't have any bias, but you're right. There are less silver projects out there. And as a result, the valuation of silver companies versus gold companies tends to be always at a very high premium. And I guess it's the bottom up cash flow valuation driven guy in me that's avoided silver for that reason. I don't understand why you pay 1.5 times NAV for a silver project and pay 0.7 times NAV for a gold project that has exact same margins, same cash flow, and same attributes, whether you're producing gold or silver. So that's the one reason why I've stayed away from silver. It's a bit, I think, too crowded a space vis-a-vis the opportunity. I'd rather be in a space that is unloved with lots of opportunity. I'm not saying silver is overbaked right now or at top, but in general, the silver stocks valuations are at a premium, and I've never been able to justify that mentally for myself to engage heavily in silver. If I have a company that makes a silver discovery or has silver as part of their revenue stream and it's attractively valued, fantastic. But it's not something I seek out because of that valuation premium versus the other precious metals I look at.
Excellent, Michael. Any other thoughts as we wrap up here?
No, it was a great interview. Really enjoyed it. We covered a lot of ground, and I really appreciate your time. So it was a lot of fun.
I really appreciate yours as well, Michael. And there's not really any place for our listeners to try and find more of your writing or anything like that, correct?
I'm relatively inactive on LinkedIn. I post once in a while on LinkedIn. For some of the companies that I'm a board member and a large shareholder, I'm an insider filer, so they can see what I own by pulling up the SEBI filings for my name. You can see what I own, what I've invested in. And like I said, I'm a pretty transparent what I do. I'm a long-term investor, so they can dig up some stuff there. And once in a while, I do interviews like this, and might be able to catch a few tidbits of what I'm doing. But other than that, appreciate your time today.
Appreciate your time as well, Michael. Thanks very much.
Thanks so much, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.